Perfect. Well, we want to welcome Andrew Russell from RCG Mortgage. He's named one of the top mortgage brokers of 2020. He's #1 on Long Island, #3 in New York, and number 69 of brokers in the United States. And on that note, you can't get more of a higher recommendation than Darryl just did, where he's willing, he works with them personally, and because Darryl has some high standards. So on that note, we are going to let you guys take it away. Again, I do want for everybody who's just joining us, please use the Q&A panel to ask questions. In the chat, you can just, if you want to just say hey to your power agents, you can use the chat for that. So little housekeeping. Thanks. Bye.
Thank you, Julie. All right, Andrew, take it away, brother.
Well, thank you. First and foremost, guys, happy Thursday. Thank you, Darryl and Julie and the team for having us on. Very much appreciated. So obviously huge fans of Darryl and his team. So again, thank you so much for this opportunity. We don't take it lightly. So a little bit of the backstory. Yes. So I'm 39 years old. I opened my mortgage company April of 17. I'm turning 40 this year, by the way, which is a little bit freaky. We'll talk about that on separate cover. But nonetheless, I started April of 17, and then I really the end of 18, I think my brand and the foundation, I'm a meticulous business plan type person. Like I spend a lot of time on the business plan to make sure that it's going to be something that works out. Obviously, I like to be successful at what I do. I'm sometimes the guy that's paralysis by analysis, which I know from a listing agent presentation, sometimes people get great advice from Darryl, kind of get out of your own head. I'm that type of guy. So with some high level coaching, I've learned to do that. And I started a little bit over a year, end of 2018, building our brand, which is really realtor business, empathizing. If I was a realtor referring a mortgage guy, what would it take for me to, number one, think that guy is a kick butt mortgage guy? And number two, well, what's the value proposition? What separates you, Andrew Russell, from the other 4, 5, 6 guys that just told me yesterday that they're the best and the fastest and the best looking with the best dance moves? I mean, ultimately, right? It's really all what the type of stuff that we all say. So I started building our brand the end of 18, did the DBA RCG Mortgage, which was mortgage specific. And then here we are, May of 2021, post-pandemic, RCG Mortgage, like this guy, this face. We're the in-house lender for 4 Keller Williams market centers, for all of Exit Downstate, which just was rolled out, which is exciting, for Laffey, for a bunch of places, very hyper-focused sometimes downstate New York. But it's really exciting that to make a business plan, to build it, right, to get the right people on the bus from a staffing perspective, in the right seat, which is half the battle sometimes, and to stay consistent. Here we are, Scotsman's Guide, which is really the most accredited mortgage magazine across the country, just came out, and that's what Julie said, that I'm the #1 mortgage broker on Long Island and #3 in the state. That's pretty cool. And I'm not a humble brag guy. I'm the type of guy, I'll let everyone else take the credit. I have a great business plan and I think people love working here, but it's for like the first time in my life, I'm a little bit proud of myself, I think, so I'm really excited about that. So again, thanks for the opportunity to speak here, guys. So, I'm going to touch upon a couple things. I think the best thing for me to touch upon, especially in this market, is a couple things, and we'll kind of open it up. I want to keep it exciting. I am not the mortgage guy that talks mortgage 101, so you guys can all be on your smartphones, bored out of your mind. I like to keep it fresh, exciting. I want you to come away from this conversation with a couple nuggets. I want you to be able to see into this big head, this brain, and kind of get some of the stuff that I'm dealing with and make your business better, learn something, help maybe down the line with an offer or a buyer presentation or a seller presentation, things of the sort, to help you do more business, do business more expedient, more efficient, things of that sort. I want to give you some good nuggets today. So, I'm going to touch upon a couple things, how the pandemic changed underwriting, what it means for the clients, product access and availability as the world opens back up. I mean, that's pretty exciting. We're great, and Darryl's phenomenal at in-person seminars and presentations. So just hearing in downstate New York that has been affected by the pandemic, that some of this stuff is opening up, is really exciting, because that's how we really built our brand, especially with power agents. What are you guys doing for networking, for brand building, for break breads, all that stuff. So, knock on wood, we'll continue the train that we're on right now of opening up. So I'm excited about that. But again, now the world's opening back up. What does that mean for product access and availability? Appraisal insight. So for instance, I work with thousands with an S amount of clients, like with an S, thousands. And I would talk people out of, you're going to waive your appraisal contingency? What are you, crazy? Literally, like, why would you do that? But now that's the new rage, right? Everybody is waiving their appraisal contingency. Why? Because hyper-focused Long Island. I'll give you a town, Huntington, which, many of you may not know, but, XYZ town, house goes on the market for $550, open house weekend, 30, 40 people line up, right? I mean, in the chat, are you guys experiencing this across the country? Mid-America, across America, because in New York, house is priced right at $550. Guess what? 620, 650, 670 are the offers. Those are the offers that it takes to get the job done from an accepted offer perspective. And then they have to waive, meaning the buyer, they have to waive the appraisal contingency. Why would you do that? What are you, crazy? No. I mean, right now, which we'll talk through today, especially in my career, it's the first market I've ever seen where it's not what the house is worth. It's what you're willing to pay for it, buyer, right? It's a completely different psychological situation as it relates to buying, because, typically you negotiate, right? You try to get a seller concession. Now it's different. Now you're lucky to just get the accepted offer. I heard from an exit agent that buyers now are offering to pay the seller's moving costs. I mean, it's getting crazy out there. It just goes to show, so we'll touch upon that quick. And then lastly, how to stand out from your competition when making an offer and when you represent a buyer. Like, literally, think about it. Open house weekend, great house, priced right, 20 offers, 8 of them over ask. How are you going to differentiate yourself, right? So what are some of the things that at least I've seen with our buyers? Because RCG, we have a big pre-approved buyer pool. So nonetheless, that doesn't necessarily mean something right now, because it's very difficult to get that accepted offer. So, we'll talk through some of this stuff. So Darryl, you want to hit on anything before I start?
No, let's just get into it, man.
Perfect. So how the pandemic changed underwriting. I love talking about this because I'm a mortgage geek. I'm 6'3", 280. Not many people call me a geek to my face, but nonetheless, I am a mortgage geek. So I'm self-employed. Let's start there. So the self-employed type of client got crushed in the pandemic, meaning guidelines changed. So typically you meet a buyer, say, hey, what do you do for a living? A realtor, we're self-employed. Oh, I own a business. I own a restaurant, whatever it is. I'm self-employed. So typically what we used to do is we would review their tax returns from a year ago, right? So what is it right now? May of 2021. So typically what we did was we'd review a year or two of their tax returns and kind of analyze a few things, usually go off of your net, and then that's what we inevitably would use. But I'm not going to say the lenders smartened up. It makes sense what they did. So now the big systemic thing is they're reviewing the last 3 months of your bank statements. Why? They want to make sure revenue is coming in. So that's been killer post-pandemic, because think about it. I mean, again, across the country, I know it's hyper-focused in New York especially, but like I can't imagine across the country restaurants weren't decimated, the restaurant business, right? Any of the service business is similar. So they're looking at your last 3 months bank statements to ensure you have money coming in. And guess what? If you don't qualify. That's a huge guideline change, because a lot of businesses, maybe a business is seasonal, but now it's like, that's the guideline. And the government, they're very objective. You're not calling anybody on an 800 number and having them talk through anything. It's fit this box or else. So 3 months, that's a big thing. We had a realtor, think about it, right? We had a power agent that sometimes power agents, you might be up and down a little bit. Maybe January you close nothing. February, maybe you close nothing. Maybe March, you close 5 or 6 of your contracts, of your escrows. April, you close 9. You have a great month. And May, you close 1. So it's, sometimes we're peaks and valleys. So we had a national lender that actually was trying to decline, as an example, one of our clients, because January and February, similar to this example, they had almost no revenue coming in. So again, we're a broker company. There's some advantages with brokers versus bankers. We're like a 9 lives versus a 1 life. One size fit all type company. So there was a lender that used common sense, because again, how do you not understand real estate if you understand mortgage? Same thing with mortgage loan officers. Sometimes the income's a little bit up and down. We were able to get the loan clear to close and close, but this is an example that even us, we're encountering a lot of differences in underwriting, specifically to self-employed. verifying these people's employment. I mean, typically you'd verify within a handful.
Andrew, let me just ask you about that
Yeah,
for
sure.
1 second, which by the way, I do want to talk to Julie. Julie, are you still there with us?
I am.
Did anybody answer Dennis's comment there?
Not yet.
All right, you can answer it now.
Okay.
Yeah, you can answer it now. As they come in, if you can, that'd be great.
Okay.
So the cash flow, so they look at the bank statements as far as the deposits that come in. Are they still looking at the tax return, Andrew? Or so
Yep.
it's combination
So it
two?
was
Okay.
just an added layer. So it's the
Okay.
typical tax return review, but this is literally just to ensure that they're going to give you credit for your income for last year, which in fairness may not exist now. And then it just, so they're going to look at the deposits. They're not all that crazy now about the expenses, believe it or not. It's just they want to make sure the business is open, operational, and money's coming in just to ensure that last year's income is still viable.
Okay. All right, go ahead.
And they put people through the ringer that are even W-2. ADP, that's how typically a lot of companies verify their payroll. I guess they had somewhat of a shutdown because of the pandemic. So, we're asking for pay stubs now within 60 days instead of 120. These things are changing now. I think that now the government's a little bit more comfortable. But nonetheless, this is why for everyone, all the power agents, it's super important you have a great loan officer, because when I tell you folks daily, if not hourly, you're getting an email about a new change, a new something, right? Especially from the pandemic. This is just something that's very systemic.
And for agents that aren't familiar with it, that's the difference between correct me if I'm wrong, like with a broker versus, I guess, a banker or something, because you have different lenders that you can shop to place that buyer, correct?
Correct. Yeah. So, I always say in my mortgage 101 conversations, there's really 4 types of mortgage companies out there. There's the FDIC, Wells, Citizens, Chase, great companies, depository institutions. There's a credit union, over here. There's a couple different names, not that everybody knows them, but I'm sure you're familiar with a credit union. There's a mortgage bank, companies like Loan Depot, Cross Country, Freedom. Those are national companies. Nova Home Loans. Those are companies that close a loan basically with like a warehouse line or a home equity line of credit, like conceptually, and then they sell it. So people say, "Oh, my loan was sold so quick." It's because a mortgage bank closes. They're not a depository institution, so they sell their loan to whoever's going to be servicing or buying loans. And then a broker company, which is what we are, which I wholeheartedly believe is the best. Why? Because number one, we're wholesale versus retail. Everybody on this call knows the difference of wholesale versus retail pricing. Mortgage is mortgage, but if you can save a quarter on rate and get to work with the best, that's phenomenal, number one. And number two, to Darryl's point, is product access. So mortgage, right, wrong, or different, is not one size fits all. FHA, VA, conventional, portfolio, no doc, some of this stuff is back. Not every lender excels at every individual specific type of mortgage. Some are better at low FICO FHA. Why? I don't know, but they just are. Some are great at rehab or renovation loans. Some are great with the vanilla 20% down, 2 teachers, vanilla type loan. They'll knock it out of the park in a couple of days. So that's what makes a broker unique and special. We align the client with the best fit for them, number one, with the best interest rate at the best pricing, and we do everything. So yes, Darryl's point, broker companies, we can align a client with the right fit. Because again, mortgage, unfortunately, is not a one size fit all. Back in the day, a client could walk into a Wells Fargo bank and get declined. They could go to a broker who sends the loan to Wells Fargo, and like us, for instance, to get declined. They could close a loan with a mortgage bank who then sells the loan to Wells Fargo, and Wells Fargo buys it. So, it's a fascinating concept. But yes, you definitely on this call need a mortgage broker company, a loan officer. That's good. Because it's kind of like a good mortgage broker loan officer is like the mortgage Wikipedia. They'll always be there to help you.
Good. Okay. I'm sorry to interrupt you. Go ahead.
No, of course. Second piece to touch upon, of course, is second homes and investments. So the typical vanilla second home and investment right now is, from a purchase perspective especially, is under fire from the government. Why? Because when you tell people to not pay their mortgage and it's okay, typically, if someone has, if you think about it, guys, if they have an investment mortgage or a second home and they have a primary, and that what hits the fan, what mortgage gets paid last? The investment, right? Because like your family's in your primary house, you don't want to obviously have issues or foreclosure and have an issue with your family. So excuse me, what has happened is the government, Fannie Mae and Freddie Mac, have imposed artificial price adjusters, right? Really, the net effect is they're limiting the amount of business you could do that is second home and investment in your portfolio. So because of that, lenders imposed higher rates, and this just happened a month or so ago. So really, the net effect is close your second homes and investments quick, because there's, in French, they say le bruit court. It just means rumor has it that like June, July, Fannie Mae and Freddie Mac may no longer do second homes or investments, or make it priced so poor that you have to go portfolio. So, products, non-QM, which I'm sure you guys have heard of. It sounds kind of gangster, but it's really just, a better version of subprime somewhat. But the point is there's portfolio programs coming out that are not backed by the government that will potentially, take the place of Fannie Mae and Freddie Mac. But this is another issue with product, which is some is good, some is bad. This is one of the bad things, that second home and investments right now are priced very poor, only because I guess the portfolio in and of itself across the country is not paying that well, because like I said, when the hits the fan, people are paying their primary first. It's a big
So
thing.
let me see if I understand what you're saying. From an investment standpoint, because of Fannie Mae, Freddie Mac, there's going to be financing available for investment properties, but you're probably going to pay a higher rate or even harder underwriting as far as qualifying. Is that right?
Exactly. So you're going to pay a higher rate / closing costs. They kind of all one and the same for now. And then there's concerns that, this is what happens with the government. I've seen this since my career, since the crash. Often, once the price gets jacked up, that's really just a predecessor to the product getting pulled off the shelf completely. So what will happen? What will investors do? How will they get mortgages? Nonetheless, there are products that are bridging the gap, which is portfolio products. These non-QM, basically the non-vanilla, and the rates should be the same or better because they don't have these imposed price adjustments that the government is imposing. So there is an end, there is like a pot of gold at the end of the rainbow in this story, which is some of these new products, which is exciting. But, don't be scared, guys, when you see some of the stuff in the news about what I just referenced, because there is a product behind it bridging the gap. But again, this is the importance of having a mortgage guy who knows what he's doing. You don't want him telling one of your clients and maybe not giving a pre-approval that they deserve and saying, you have to put down 50% and the rate's 5%, when there are companies that could lend with a higher leverage amount, a less down payment, and even a better interest rate.
I will tell you that this is an important, because some people are asking where you're located too. And from a concept standpoint, like even if you're not in a state for somebody, the concept I'm going to share about you, Andrew, is that, because you just made me think about it, is that you've got to be careful as an agent that your loan officer just gives out pre-qual letters or pre-commitment letters like it's candy without really knowing, hey, can you really finance this buyer? And like before I made investment decisions, I checked with you to see, can I do this? Is that an option? Because if it wasn't, I didn't waste my time in negotiating a deal to buy a property. So I guess you need honest coaching from a loan officer who knows the products, so they can give you the best advice for your clients.
Yeah, so I say in most of my, in-person seminars and speeches that absolutely. So typically across the country, there's a horrific, horrifying statistic. Over 50% of pre-approvals issued across America are actually incorrect. There's something wrong. It's, we say would, right? Like it's basically, something is wrong inherently with the pre-approval, which means either it's wrong and they never were pre-approvable, or like it's off. It's either too much or something's off. We've had people here, some of our realtor partners are great. They say, hey, listen, I respect the first person you got pre-approved with. Look, it's free. Give a call to our in-house guy, someone on Andrew's team. Speak with him. It's always worth a second consultation, just like anything in life. We've had people speak to buyers and say, hey, looks like you're pre-approved for $600,000 with 20% down. So like, can you go into your sent box and forward us what you forwarded to the first mortgage guy? What do you mean? I didn't send him any docs. We're like, what? Yeah, like he didn't even run my credit. He asked what my credit was. I told him what I did for a living, and he sent a pre-approval.
Yeah. See, the problem with that is now if an agent starts running around with a buyer, and especially in this world of multiple offers, for the $600,000 buyer, putting an offer here, putting an offer here, putting an offer here. And if they finally get one accepted, and then push comes to shove, they can't get the loan. That was just such a huge waste of time for the agent. So you've got to make sure that the pre-qual is not just a document that they just printed out just to give it to somebody. Yeah, that really is true. Okay. Let's go on with what you were saying. Good stuff. This is great stuff. Go ahead.
Yeah, I mean, listen, I empathize. Like, think about it. You're not going out with your buyers, showing them 4 or 5 houses and getting an accepted offer. I mean, those days are over. You're
Right.
viciously in a dogfight to get an accepted offer. Now imagine once you do that and you're so proud and, I mean, realtors are feeding your family with these commissions. I mean, it's not all about the money, but like at the end of the day, it's what you do for a living. Imagine you find out that the loan officer didn't do his job and it was all for nothing. I mean, it's horrible. So, these are some of the things that we're seeing ultimately with this systemic market, right? So from a product access and availability perspective, somebody in the chat wrote something about a no doc. So yes, so there is now, and it's coming back, a 20% down no doc program, for self-employed, right? They definitely want to make sure that they have good credit. So, I mean, look, I'll touch upon something quick. There's articles weekly now, guys, about here we go, it's just going to be another bubble. I disagree wholeheartedly. Why? Because compare, and anybody in the economic world would disagree. Why? Because compare the current mortgages and market to the previous. Everybody right now, typically, we are verifying their jobs through and through to the last second they sign that loan. The loan docs, we're verifying they have a job. People are walking into purchases with more equity now. Right now it's difficult to do the low down payment loan options because sellers won't accept it. When you have, think about it, power agents, right? Darryl's the listing genius. So like when you get your listing, what are you going to accept? You have 40 offers and some of them have 20, 30, 40% down. Which ones are you going to accept? Typically, you're going to do the higher down payment option. So my point, we're checking people's jobs. The credit scores right now are higher. There's more equity in these houses because of these higher down payments, which means people have more to lose if they foreclose. People are taking 30-year fixed rate mortgages. The adjustable mortgage days, I mean, we don't give I would say of 100 clients, 100 get 30-year fixed rate mortgages. So there's no worry about adjusting and refining and all that stuff. So look, could there be, like, we're having a spike? Could it like tailor off a little, in my opinion? Sure. But nonetheless, I can't imagine, because the job market, at least over here, is doing pretty well. So I can't imagine any issues that we had in the past, meaning, there's no equity or we were negative equity. Adjustables that are adjusting and now people have to refinance, etc. So I don't.
Let me get clear on that question. So is there 20% no docs now?
Yes. So, but to a products availability point, if you have over here in the 700s as a credit score, you're self-employed, and you can put 20% down, you can now purchase a house. Someone in the chat wrote rates in the 4s. Usually, from what I'm seeing, 4s or 5s. Just understand in New York, we are very, 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 very regulated. So outside of New York has a lot wider product access. New York is a little more stringent on allowing products within the state, believe it or not. But 20% down, self-employed, you can get a no-doc loan. Absolutely.
Okay, very cool. By the way, while we're on it, being that we're jumping to these questions, is it all right if we jump to some of the questions now, or you want to continue with your outline? All right. What about HELOCs? I was told by a mortgage broker the banks don't want to do the HELOCs.
Correct. So HELOCs, home equity line of credit. It's a second mortgage typically. It could be a first mortgage. All it is, how I describe it, guys, is conceptually a cash advance credit card on your house for pennies. So it's usually based off of prime. We don't offer HELOCs. Most companies that offer them are usually like if they'll go to the credit union or maybe like a TD Bank as an example nationally. But it's very, very, very cheap. It's usually prime, which is like 3. And then depending where you are, plus or minus. So say 3%, right? So say you borrow $100,000, just to keep it simple, because I'm a math geek. 3% of that for the year is $3,000 divided by 12, $250. That's how you get the payment. So if you borrow $100,000, it'll cost you $250 a month of interest for that $100,000. Some people would say that's really cheap. I mean, if you put it into the market in the right kind of capacity, depending on your advisor, you should do pretty well. So home equity lines of credit are phenomenal. But to the point of the chat, yes, banks do not like doing them anymore. Why? It's the same concept. Is a home equity line of credit is typically a second mortgage. If the you know what hits the fan, the statistics, this isn't just somebody somewhere in a room saying, I don't know, like the statistics nationally over thousands and thousands and thousands and hundreds of thousands, millions and billions of loans has shown those are paid last. So nobody likes to be paid last or not paid at all. So that is the reason that home equity lines of credit have been somewhat pulled off the shelf, because yes, if there's a risk of you not being paid. I mean, people lend to be paid, right? We're going to give you this great program, but we would like our money. So if that's not something that's going to happen and they have statistics to show that, they're going to take it off the shelf. Home equity lines of credit, that is definitely one of them that is usually paid last.
Gotcha. You're saying about the bubble and stuff. Do you think that there will be a challenge of foreclosures in the future, just in general? Because I get that a lot, like because of the prices of homes going up so much, there's a concern that at some point, the party's going to end for these prices and things will start coming down. What's your take on that?
Yeah, I mean, look, if you look at what happened before, it was the rate of appreciation in America was ridiculous, right? But, and again, it's kind of very hyper-focused now and it's happening somewhat, but it's also a huge supply and demand thing, right? The supply and demand right now, there just is no supply. People are not selling, for instance, in our area as much. So when a house comes out, you have all this stored demand because we missed our spring with the pandemic, right? So what happened was this market is very hyper-focused. So people miss the demand. I think it was like June, July, the end of the quarantine, somewhere around there. I mean, I'm getting old. Remember, I'm turning 40, so my brain is a little bit going. But, but they ended the pandemic, right? The quarantine ended, or the pandemic, the quarantine ended during the pandemic. People came out, oh my God, school start. Think about it. School start in September. Right. I got to get into a house. There were like 40, 50, 60 people online for an open house. Of course, nobody got an accepted offer. Everyone's bummed out. So then it's like this super stored energy for this spring. Same thing happens. I'm not going to miss out on a house this year. My husband's busting my chops and my wife's busting my chops. Like, we got to find a house to get into the school. I'm sick of being outbidded. So it happened again. It started in February, March over here instead of April, May. It was pretty wild. And then here we are again. It's just one of those things that it's just super hyper focused with this market. But I do not think that there will be, listen, I'm not an economist, but I do not think that there will be a bubble. Why? Because I think it's going up and it'll curve a little and stop, right? Yep. Eventually, I think the demand will somewhat reach the supply, and this madness in a year or so will go away. I don't think there'll be a dip. Why? Because people are taking 30-year fixed rate mortgages, specific to, especially in this market over here, people can't afford 15-year fixed. I mean, 30-year fixed is an American mortgage. In Europe, they're based on a 15-year amortization. So it kind of artificially let the house prices go up a little bit because you could afford more. But nobody's, I would say, out of 100 mortgages, 101 take a 30-year fixed. Like, no one really opts for a 15-year. It's not really affordable, especially in this area. So what does it take to have a true crash? Typically, mortgages that are being reset, and then they have to be refied. That's not happening because we're in fixed rates. The job market over here is pretty healthy, less maybe the restaurant business, so that's obviously good. And there's more equity. During the crash, it was like everyone started becoming negative equity. Here, there's more money being put down and it's going to flatten a bit. So my personal opinion would be that we're going to be fine. I think people have to unfortunately rent for another year for the craziness to pass us. I would never want to be a buyer right now, but I do think it'll flatten out.
So somebody, one of our power agents, Letitia, am I saying that wrong? Sarah?
Letitia.
Letitia, sorry about that. Andrew's the best. Years ago, a listing of mine did not close and the buyer was very upset. Andrew told me to give him a chance and he closed that loan that looked impossible. The lady still has that 4-family property. Good job, Andrew. All right.
Hey, Darryl.
You got a fan. Yes, Julie.
We have a lot of questions. Do you mind if we jump in on some of those?
Shoot.
Yes, let me ask one more and then we'll jump to those questions, Julie. Thank you so much. The one question that I wanted to ask you was about things not appraising. So are you finding that's a challenge? So talk about the whole appraisal thing, because property values are going, buyers are paying well above. I tell people now we should not call things asking price. That's now, we should say it's the starting price. of a home. And
I actually haven't heard that, and I like that. I'm going to steal that. So I hope that's
yeah,
not
yeah.
trademarked.
So yeah, it's the more asking price. It's the starting price.
It's so true, though. So true.
So what happens when a buyer pays over the list price, and about the concern about it appraising?
So, I mean, it's a great question. It couldn't be more pertinent and prevalent, especially in this market. So this is what I would tell you is the good news is if there's any silver lining to all these underappraised houses, PMI, which is when you don't do FHA, right? You do a conventional loan, you have less than 20% equity, so it's PMI, has gotten a little bit more aggressive. The calculation's better in the borrower's favor, credit score requirement loosened up. So really it has to do with like our consultations for buyers. A great mortgage consultation for buyers has to include, hey, are you prepared for this house to underappraise? If it does, this, like, we almost prepare for the worst, you know, type thing, because it's systemic. So, you know, appraisals come in under. Contracts right now, it basically, you know, from the last several that we received, there's like a clause, and I'm not an attorney with the magical clause, but it says something to the effect that the buyer agrees to continue with the purchase regardless of what the house appraises for. Basically, you're waiving that, oh, well, you know, the house came in for 500, I'm buying with you for 6, let's renegotiate. You're basically typically killing that out in the contract. So what happens? Really, I would just tell you, you need a good, buyers need a great consultation. Now more than ever is why it's important for a good mortgage guy, because think about it. You know, the purchase market, especially in New York, an attorney state, you know, there's deposits on the line, 50 grand, 20 grand. It could be 20 grand, which doesn't sound all that much versus 50, but that could be the last penny that these people have saved. You don't want that at risk. So you have to understand as a buyer what you're getting into. So typically, it depends on the contract. The contract is law. So people are waiving that. They are prepared to pay the difference because they're that desperate to get into a house. When it's not in there and it still comes in less, it's a renegotiation. It's either, hey, let's meet in the middle, which is super popular. Sometimes in contracts, it's saying, you know, if you're buying the house if the house is on the market for 700 and you're buying it for 800, the buyer agrees that as long as it comes in for 750 or above, like they're going to pay like up to at least 750 if it underappraises. Like there's all new caveats. It's almost like let's make a deal now in contracts, but it's definitely a systemic thing. Buyers have to be prepared for if and when it underappraises, because most houses are underappraising. Okay.
So most houses are underappraising. So therefore the buyer's got to be prepared. And that's really great advice, because I've never said that before, Andrew, but when you're sitting with the buyer for the first time and you're a coach and you're meeting them and we're going to go look at houses, there needs to be that conversation about, assuming you find a house that works for you, are you willing to pay more than the asking price or starting price? And if it doesn't appraise, you need to be prepared for that as well. So great stuff. Julie, let's go to your questions.
Awesome. We've got a lot, and I'm just going to take them from the earliest question on. So Bud asks, if a buyer gives the seller a rent back or an extended occupancy for more than a month, is that a problem if it's in the contract?
So the caveat there is if in the contract. So there's rules and regulations for when you close on a home, how long until you move in as a primary. I think it's 60 days. I'm always now, because, you know, I'm a dad of 2 little girls. I'm turning 40, going to defer and say that, you know, my brain's a little off with my old age, but my spider sense says, I believe they have to move in within 60 days, and it could even be 30. We can fact check that for you guys. So yes, typically, can things be worked out at the closing table? And, you know, maybe there's an extended or a rent back. Sure. When it's in the contract, sometimes it becomes problematic. Why? Because that buyer has to move in by a certain amount of time where it's not considered a primary residence. 60 days. Thanks, Candace. And that's what I thought. So I was right. You always go with your first answer. But still, you have to move in by a certain amount of time. Otherwise, the government thinks you're playing games. It's not a primary, which technically is occupancy fraud. There's not many frauds left, right? Income we check through and through. Credit, you know, like you have to go to the closing. Like there's a lot that we do. The property, I mean, appraisers are put through the ringer. But, you know, some people, unfortunately, buy houses and don't move in. Some people buy as an investment and move in. It's a big problem, right? So yes, it's problematic in a contract typically if they're not going to move in a certain amount of time, because they're signing on the dotted line on a federal document that's basically saying that they're going to move in.
Okay. All right.
Andrew,
Next question.
Can you cover what states your team represents?
Sure. New York, New Jersey, Connecticut, Florida, Colorado. Of course, because Darryl is basically family. If you have any questions, feel free to reach out. Obviously, we do everything we can for our power agents. So if you have a question, certainly reach out. But our company actually covers tri-state, New York, New Jersey, Connecticut, Florida, and Colorado.
Perfect. And I've put Andrew's contact information in the chat. And Andrew is actually a power agent member. So you can also find him in our power agent group. Eric asks, I've had a few afternoon closings fund the next day. What's with that?
Assuming that you're in like a state like New York where they're supposed to fund, that's not good. That's what's up with that. No bueno. But listen, the truth of it is lenders are very busy. And I'm just talking to you guys from a company owner. I'm a broker. It's not my company funding. But like from what I've seen, right? I'm in the war. I see it. So lenders are very busy. When people are very busy, your conveyor belt is tested. Not all lenders across the country, even the huge ones, I'm not going to name names, but the ones that are backed by hedge funds, billion-dollar agencies, their conveyor belt is not the best. And we've seen that. And our clients have suffered, not because of us, because the lender, a wire isn't ordered in time or it was sent out. I mean, when I tell you guys wires is like, they got caught up at the Fed, they go out in the second batch. It's like, you're like, I don't understand. The loan's been, I'm sure Eric agrees, the loan's been clear for a week. Order the wire a week ago. It's not how mortgages work. Sometimes we correlate it to the car business, how easy it is sometimes to like lease a Toyota. It's so different in mortgage with so much money. But yes, do loans on purchases sometimes not get the wire the day they're supposed to? Unfortunately, yes. What's up with that? Just no bueno. It's a lender issue, and it does happen. It's just simply a mistake. It's an inefficiency in the conveyor belt. That's all it is, but it does happen. Absolutely.
Okay.
Thank you.
Andrew.
Andrew, can a person do refi having just changed jobs after 19 years?
Absolutely. Depends on what the job is, right? So when you go W-2 to self-employed, triple no bueno. That's a big... So, you have to typically have 2. Sometimes we're okay with a year. And this is nationally. This isn't RCG, guys. This is a great mortgage broker nationally. We follow the same guidelines. When you go from W-2 to self-employed, that's the only time it gets typically a little bit spicy, I call it. But if you're changing jobs, if you're a nurse and you're making 80 grand and you go to a company manager admin and make 120 grand, but you just changed jobs, it's fine. You're allowed to do things of that sort. It gets a little bit dicey when you want to use at the new job, overtime, bonus that you didn't receive, commission, hourly or base income is very easy as a rule of thumb. When you start getting in the exotic, it's called variable, meaning like it's not consistent, right, guys? Like overtime, bonus, commission, things like that. That's when you still can use their income, but it becomes a little bit more dicey if you can actually use it. And some of it may be disqualified. But if you hear someone goes from W-2 employee to self-employed business owner, bad. That's very bad for mortgage, very bad.
Okay.
Thank you. Virginia asks, pre-approval letters being waived all over the place, but they haven't even filled out a loan app. Lenders not even signing. I have to tell buyers that they are not pre-approved in this case, correct?
So pre-approved, what does that mean? If you're asking Andrew Russell, me. So pre-approved means a good loan officer checked their credit, their income, and their assets. Those are the 3 keys to pre-approval: credit, income, assets. So what does that mean? Credit, you have to do a tri-merge credit pull. That's it. Like, you don't have someone screenshot their Credit Karma, folks. Like, you have to literally, and we've seen it all, but you have to have your credit pulled, and then it's the fallacy. Oh, if my credit's pulled, my score is going to go down. It's not exactly true. If you have a score in the 580s or less, yes. The more you run it, the more it goes down, because the bureaus understand you're trying to get credit, but you just simply can't get it. So for whatever reason, there's a harmful effect. Typically, mid to high 600s to 700s, one credit pull, which lasts 4 months, does not affect your score all that much, if even more than a point or so, which will make a huge difference. But that's the first piece, credit. They have to have their credit pulled. Yes, sometimes the pre-approval is just error. The credit wasn't even run. Income, we have to review the income, meaning W-2 employee, a month of pay stubs, 2 years W-2 forms, right? And then there's, even from there, there's a heightened review depending on if they have hourly or bonus, overtime, etc. So It's a lot that goes into income review. That's the second piece, which is income. Third, assets. Some loan officers cut corners and they don't ask for asset statements. And then to a point I'm seeing in the chat, cash is no bueno. I don't think it's ever been bueno. At least in mortgage. In real life, maybe it is. But nonetheless, we have to verify you have your money in the bank seasoned for typically 2 months. There's deposits now. Think about it. It's a new age we live in. We have Venmos, we have Zells, we have Cash Apps, we have PayPals, right? So, you can't just get $8,000 on PayPal and think no one's going to ask where it's coming from, right? The government wants to know. And listen, we don't report to the IRS. The mortgage lender doesn't report to the IRS. They just want to make sure that's viable money, per their guidelines, that it's not cash on hand, that it makes sense for them to have. So pre-approvals, there's a lot of craziness. Like I said, for every 2, think about it. I have a stack of pre-approvals. I have 20. 10 of them, probably the person didn't do a good job. That's a very bad average, 1 out of 2. So just make sure the loan officer does the 3 things. Listing agents are good listing agents. They call the loan officer on an offer and say, hey, did you verify the credit? Did you verify the income? Did you run the automated approvals through Fannie Mae, Freddie Mac? Did you check the assets? Those are important questions, guys.
By the way, that's you do that in reverse as well. So if you have an offer and you have the loan officer of your buyer call the listing agent saying, I want you to know that this buyer, here's what I did to make sure that they're solid with their offer. So you can have the loan officer help push your offer through to that listing agent, especially in a multiple offer situation. That'll really help. Go ahead, Jules, next question.
Hans asks, why recommending Freddie Mac as opposed to Fannie Mae as investor? How do you handle almost cash buyers of certain cultures that keep their money primarily in mattresses and cannot show proof of funds?
So great question. So look, Freddie Mac versus Fannie Mae, there's some caveats there. I mean, the typical advantage of Freddie Mac versus Fannie Mae is if a business is open, self-employed for 5 years or more, Freddie Mac automatically uses a 1-year average versus 2. That's always been a huge advantage. Also, the way they calculate income on self-employed, especially as it relates to corporations, guys, not to get too into the details, on Freddie Mac is more aggressive. It's more easy to get to a higher number than Fannie Mae. Again, this is why you need a good mortgage guy. It gets a little bit mortgage speakish, but they're each somewhat similar. Freddie Mac and Fannie Mae, both conventional mortgages, typically their guidelines are closely aligned. One cool caveat, this whole student loan systemic issue, Freddie Mac, if there's no payment, typically they'll go on 0.5% of the balance versus 1%. So in other words, if the deal is tight, right, and the guy has $80,000 in student loans, Freddie Mac will hit him for $400 a month versus Fannie Mae, $800 a month for a payment. Little cool nuances, but typically they're very similar. The cash thing, I mean, some of these just to keep it simple, some of these no-doc programs, they allow you put the money in the bank and then you close in a month. They're not so concerned, some of these new portfolio programs, with a 2-month seasoning in the bank. So I would tell you to reach out to your mortgage professional, ask them about some non-QM stuff, because they're way more lax with bank statements. But just think about it. Mortgage guidelines are objective. Where's the money coming from? Cool. We need to see it. Great. How long has it been there? If less than 2 months, they'll see a large deposit. They'll question it. If you have no paper trail, can't use it.
Okay.
Thank you. Can you explain how seller financing works? A buyer is offering to pay 4% to my seller to finance the home and then will pay cash when their home sells.
It's a great question. I don't necessarily know the answer to that one. So typically, but think about it, right? So if a seller is willing to finance the buyer, there's no rules. I mean, it's basically
there's no underwriting. You just do that deal. Yeah.
Yeah. So there's really not much to explain per se. In fairness, all it just means is, listen, the seller is willing to hold a note at 4%. It's almost like an artificial mortgage with terms, but there's no vetting. There's it's literally, I will give you money at this rate. Are you cool with it? But it's outside of a mortgage guy's realm, if that makes sense.
Well, what I would say though, quite honestly, is that if I were the homeowner, I would be charging a lot more than 4%.
Oh my God, with that risk? Yeah,
you're with that risk. Yeah, you don't want it. So I don't know who you're representing on that, but the homeowner should be charging more than 4%. The buyer doesn't have to worry about closing costs as much. The seller's taking a higher risk. So
deal of a century. Yes.
The deal of a century. By the way, what's the address of that house? Maybe I'll do it. All right, go ahead.
Andrew,
Next
how does,
question.
two things. Sarah, will you go into the chat, please, and have people ask their questions in the Q&A, because it's getting a little muddy here, trying to keep it all together. Janet asked, how does a buyer waive appraisal when conditioned on loan approval?
So just to be clear, guys, great question. I appreciate you bringing this up because, again, mortgage guys, my company, what I champion is do not speak to realtors and buyers like we're files and DTIs and LTVs. So it's the same thing here. I want to make sure that what we're saying, I say it, multiple times a day. I want to make sure that it's making sense, because sometimes mortgage guys, we sound like we speak Greek, right? So you need, for a mortgage, you need usually always a appraisal to close, because the bank is lending based off of what that appraiser, who's very regulated right now, apparently before my time, it was, the guy came in 20 grand short, give him a call, the appraiser, and say, if you don't bring it up 20 grand, I'll never use you again. And that was obviously before the crash. And then look what happened. So now, you cannot pick your appraiser. There is a management company you have to use who arbitrarily on a one-off picks an appraiser. So there's no collusion. So once that happens specifically, the appraisal, that's something the lender needs to discern. What is this house worth? Because that's what we're leveraging, right? So they're taking a position of a certain amount of equity or vice versa. They're lending a certain percent off what it's worth. They don't care that someone's willing to pay $1 million if it's worth 500,000, because listen, guys, it's all about if there's a foreclosure, if what hits the fan and now the bank owns that asset, what is it worth? So the lender will still ask for an appraisal. It's just what you're waiving is not that you're doing an appraisal. You're waiving the right that if that value comes less, that you can renegotiate. Mm-hmm. I'm not paying $1 million for something. It's only worth 500. Well, guess what? In New York, especially, if you waive the right of an appraisal contingency, all you're waiving is that you can renegotiate. You're, out of luck, you're paying that balance, the difference. So you're not waiving the actual need for an appraisal. You're waiving what happens after, the ability to renegotiate. You're basically going in blind, whatever this appraises for, I'm buying it. And many times it's just simply a crapshoot.
Awesome.
Yeah. So essentially, if you waive I've got to just run my brain on this. If you waive the appraisal, you're almost waiving are you waiving the mortgage contingency on that, or no?
So
you're not.
You can still be declined for reasons outside of the appraisal.
Let's just stick with the appraisal. So if I go for a mortgage, the contract is subject to me getting financing.
The only thing you're waiving is the value as long as something related to the value, none of that can have an issue. Specific, if you don't have the money to bridge the gap, the seller will not accept the denial that you don't have enough cash to close and then give your deposit back. It has to be a reason outside that. So all you're doing is waiving that value having any type of issue on your mortgage.
Right. Okay.
Now the house still has to be, depending on various things, it has to be in a certain condition typically, and that could be something negotiated out. But the value, the seller netting what they want to net, no matter what it appraises for from a bank perspective, that is what you're waiving. That no matter what it comes in for value-wise, you will proceed no matter what.
Or lose your deposit. Got it. Go ahead, Jules.
Exactly.
Awesome. Margaret, any advice for buyers to fix their credit score to get a better chance to get a better percentage loan?
Yeah, so typically, if you work with a mortgage broker company, the best broker companies with their credit companies, we have to get signed on when you open a mortgage company with a credit company to pull credit, right? So for instance, we use Universal, big shout out to Katie Howell, the best rep in the country. So we pay a lot of money for an algorithm that tells us. So like when I pull your credit, when Darryl Davis calls and I see he has an 800 credit score, under each of the credit scores, right? There's 3 of them: Experian, TransUnion, Equifax. Under them, we pay a lot of money to see if a client pays up to $5,000, what we can improve their credit score real time. So in other words, if for some reason Darryl Davis before the holidays charges up all his credit cards buying his family gifts, and they're, typically your score goes down when you're at the limit, right? We say, Darryl, those 3 cards, your Macy's card, your Best Buy card, and a third card, pay them down each to like a net $10 as a balance, right? Do that today. Tomorrow, send me a screenshot of those 3 accounts, and I can, on your behalf, resubmit it to the credit company. It takes about 2-3 days, and voila, you'll have the new credit score. So the answer is yes. Mortgage broker companies typically have access to coach clients through this computer program and say, hey, if you pay down these cards and show me proof within a couple of days, I can improve your score, which will give you either higher purchasing power or a better interest rate.
I want to, while we're on that, I'm going to answer this Dana question that because it's in line with what you just said. She said, what if a loan officer lets you know 2 days prior to closing that a buyer has to pay down a car in order to get a commitment? Why didn't they discover it sooner? Well, it's very possible because you run a credit twice, right? You run it when they do the application, and then sometimes just before closing, they rerun it again. Am I correct on that?
So typically, lenders will allow one of 3 ways to review a credit before closing to ensure there hasn't been any changes. One is very liberal, one is very conservative, most are in the middle. So the 3 ways are as follows. The most liberal, the most aggressive is we still have lenders that at closing, the client signs an I swear.
Right.
Literally. Like, I promise Mr. Davis, I have not opened up any new trade lines, leased any yachts, bought any other houses. Like, literally, they sign that and that's it. Most don't do that because that's a little bit cowboy. The other side of the fence is, it's called a soft pull. They re-pull your credit without affecting your scores, but it's basically another pull real time, which could affect you. I mean, listen, nobody needs their credit pulled a week before closing. You don't know what happens if your debt to income ratio, right, are magical words. But like, if your income is real tight and say you charge up your Amazon card, that could affect it. So that's something that typically you want to avoid, lenders that do that. And in the middle, that's what most do. It's called debt monitoring. So what they do is, when they intake your loan and underwriting, they set you up for debt monitoring. And all debt monitoring is has anything been added, like another trade? Has another trade or account been added to your credit? That's it. Or have you had an inquiry, meaning like you tried to take new credit? But to your point, to Dana's question, look, nobody likes the back and forth at the end. I can tell you that here at RCG, that never happens to clients. But listen, the truth of the matter is, being a mortgage loan officer and the mortgage business in and of itself, there's a million potential landmines that we have to run through. There could be a million reasons that happened. Maybe the person, like to Darryl's point, they just discovered they opened up this trade. Or, maybe something happened with their income that at the last minute, the employer, in fairness to the mortgage guy, the employer says, no, that over time it's not likely to continue. And that lowered his income, which means his debt ratios went up. So now they have to, so I would more so say, look, and this is my net answer. And then like the mortgage guy would definitely give me a pound for this, right? So we always say here at RCG, we're going to get you to your destination with a great flight, typically maybe a bump here and there, and you'll always land good. Yeah. Unfortunately, post-pandemic, a great mortgage, not even great mortgage companies, what do we say? There's going to be a lot of bumps, Mr. Davis, where you're always going to land and you will be alive at the end and you will enjoy your vacation. But, guess what? There's going to be quite a bit of turbulence. So that's all I'm seeing from Dana is, look, most loans have turbulence, even the easy ones. As long as this wasn't something that could be discovered earlier, yes, things happen. Should it be discovered earlier? Maybe. But for all of us, things happen. And as long as that loan closed, you should be happy.
All right. Next question, Julie.
What's your take on potential foreclosures? Banks can't technically throw people out of their homes, but that won't last forever.
We actually kind of addressed that earlier. Let's go to the next one.
Perfect. What's the interest rate on a 20% no doc loan?
Typically, to the point, they've been in the 4s to 5% on a 30-year fix. 4s if you're lucky. Typically we're seeing a 30-year fix in the 5s. Everyone hates hearing that because rates are in the high 2s to 3s. But guess what?
But if it's a no doc, you're going to pay. Right. So
listen, several years ago, 30-year fix was at 6.5. Now you can be in the 5s and show nothing. So it's still a great interest rate.
Yeah, no, listen, the fact that they even have no docs again, when we didn't have it for so many years after the bubble, is a blessing. Next question.
Assuming it will take time for people to return to offices, do you think more office commercial properties will be converted into housing stock, easing some of the current crunch?
I don't know. I mean, listen, I'm not a commercial guy per se, but my takeaway, especially in New York, is as follows. My takeaway is the Chase, I think the owner of Chase is basically saying they're sick of not seeing people. They want to go back to the office. The owner of Zoom, I mean, listen, we're on a Zoom. The owner of Zoom says he's sick of Zooms, right? So listen, putting this all aside, guys, we are not robots. Efficiency, right? Tongue twister always. Sure, staying at home, logging into a Zoom, you're more efficient. You don't have to get up, you don't have to do this, you don't do that, you don't have to change, all that stuff. You could log back in at night, but humans are humans. We have to interact. We are a species that needs interaction with other humans, right? It's just one of those things. The guys need to hang out on Sunday and watch football and make fun of each other. The girls typically have to go and get their nails done and be with their girls and talk about, whatever's pressing for them. So I think as a species, we need human interaction. So although it's, for a minute, we're like, oh, that's the end of industrial and, going into the office, I disagree. I mean, my company, we have social distancing here and mask mandate and all that stuff, but we love the environment here. We like being around each other. So I don't think it's going to go as far to the left as we thought, with people just not going back into the office.
All right, go ahead, Jules.
Now, just as while we were waiting for FHA case number for 2 months and the deal fell through, lender told us that usually it's 1 week to wait. Even if you consider COVID, I think it's not so good on their side. Is there any way to fasten a process, or is there a complaint department for the FHA?
So FHA is backed by HUD, Housing and Urban Development. Housing and Urban Development is probably if it wasn't for them, the country would have crashed with mortgage, right? I'm not sure what they're responsible for, but they're responsible for a ridiculous amount of mortgages. So here's the problem. I'll ask all you guys, everybody on here, a power agent, you're all a business owner, right, Darryl? I mean, they own their own business. So as a business owner, let me ask you guys, the biggest agency or one of them in the world, they're doing paper still. They're so antiquated. I understand their computers are from decades ago. They're on paper files. But the point is for them to stop what they're doing and then improve their processes and how they do things and their SOP, and just, it would basically, they would have to stop production of all government mortgage, I understand, for about 2 to 4 weeks, at least. That would it basically would destroy the housing economy. It's impossible. Right? Like the IRS is closed for a couple of days, mortgage guys lose our minds. So yes, is the FHA process a little antiquated and frustrating? 1-800 call FHA. It's hard to get someone on the phone. Sure. But just so you guys know, what it would take for that business to become a 2021 business moving forward with technology, from a technology perspective, it's literally impossible. The country would have to stop what it's doing for almost a month to do so.
Thank you.
Okay. It seems like I just noticed a note that we're going to do more rapid fire answers. So go, Julie.
Awesome. So Victoria, the forbearance is increasing because of COVID. What suggestion do you have for the future of the real estate market? Is there going to be a foreclosure market again?
I don't think so.
Nice. I love that answer. Buying a vacation property, how much is the lowest down payment the buyer can put in?
Typically 10%.
Love it. If a couple have their mortgage and want to refi, but their debt to income is high, is there a way to refinance?
Depends on the reason why the debt to income ratio is high, but nonetheless, typically no. The government has come up with a number, and if it's higher than that number, they don't qualify.
Are the requirements the same for refis? I'm not sure if you're the same as what. So clarify that for me, Dennis. Dana, what if a loan officer lets you know 2 days prior to closing that a buyer has to pay down a car in order to get commitment?
Yeah, we talked about this one. You missed the closing gate, but I'd like to know, did the loan close? And if it did, hug that mortgage guy. His job is hard.
Love it. Can we have our clients be fully approved in order to close early and compete with all cash buyers?
Yes, you can have TBD commitments, which is not just a pre-approval. It's a to be determined commitment, which helps your buyer power because it's an actual underwriting approval. Yes.
Thank you. If a house is selling for 800 and the appraisal comes at 780, does the buyer have to come up with 20,000 cash?
Yes or no, it depends. It depends on how much they're borrowing, because if that client, 800,000, is putting 20% down and under appraises, then technically they have room there that they can keep the cash out of pocket, just add PMI typically, depending on the qualification. So the short answer is you don't always have to come up with the difference depending on what you were putting down initially.
Awesome. Can you request to have a file underwritten if property is TBD?
Yes.
Andrew, can you do non-warrantable loans for condo townhouses when there is ongoing litigation with the HOA versus the builder?
Yes. Depends on what the litigation is.
Wonderful. What is the specific language to ask the loan officer to verify they truly vetted the buyer? He said it was just the terminology.
Yeah, so when you verify, great question, Larry. So real quick, to make sure you verify them, it's credit, income and assets. Did you run their credit? What documents did you pull from an income perspective? And did you review their bank statements? Did you, if I were you guys and I was a listing agent, I could never be a realtor because I'm a control freak. I need the ball, 4th and 1. I have to have that opportunity. But if I was going to be a listing agent and a power agent from a realtor perspective, I would ask for a copy of the DU. Literally, like desktop underwriter. Ask for a copy of the DU. That will show you everything on one piece of paper.
Fantastic. Hans says, I have a current case where the lender is requiring a flood insurance policy along with the HOI for a property where FEMA states it is not a flood zone. How can my clients fight that, or can they?
Lenders only ask for flood policies when they run a flood cert and it shows they're in a flood policy, or a flood zone rather. So something about that seems off. A lender runs a flood cert internally, and if it says they're in a flood zone, voila, you need a flood policy. So something about that, there's something going on.
Thank you. Dennis's was requirements for refis is the same as a new mortgage.
Typically, I mean, it depends. For a credit score, yes. Typically, absolutely.
Thank you. What does a 20% no doc mean?
What it means is this: 20% is the down payment, right? For whatever reason, always 20% is a strong down payment. No doc. No doc means they will not review your income to qualify. It's based more so on credit and assets. Do you have usually a 720 score or above, right? Which is good. And they review the profile, number one. Number two, your assets. They want to see a lot of money left over. So if the you know what hits the fan, these people can pay their mortgage for 1 or 2 years. But no doc just means, and it's a great question, that income, we're not ascertaining a monthly income amount to then figure out what they qualify for from a mortgage perspective.
I'm just curious, is that underwriting quicker?
It used to be slow and horrific. Now it is very good. I think that these lenders have realized so I think the truth is there's more money to be made on these portfolio no docs, Darryl. They're not rates high 2s, low 3s. There's more money, and lenders like money. So I think they realize there's a huge niche in the market for these. So they've invested, they staffed up. So now, like I could say from experience, we over the last quarter have done a lot of these no docs, and the service levels it's a complete 180. They're
awesome.
quicker.
I do want to add a question, Julie, and that is, or a statement maybe. So one of the things that I learned with you, Andrew, correct me if I'm wrong, is that buying investment properties and getting the financing as an LLC is really not a good option, that it's better to buy it privately and then move it into the LLC later. Am I correct in that?
I mean, you can buy. So listen, the net answer is, I can only speak now about the current market yet again. I think by the time people start looking into buying with investments, they're going to be portfolio, and portfolio mortgage lets title be in an LLC.
Okay. Go, Julie.
Yeah, that's a big change. Larry, yes. As long as the buyer gives the authority for the loan officer to release the DU. And guys, if you just take away DU and you're a listing agent, I gave you a huge nugget. You need to get the DUs. The buyer can give the authority, the legal yes, for the loan officer to release the DU. It's a PDF, right? Nothing crazy. To the listing agent and for the seller to review, because that has everything. Credit score. What do you do for a living? How long? What's the payment? How much debt? How much you have left over? And if you guys need some coaching when you start getting DUs on what to look for, I'll certainly give that. But yes, it's the same thing with credit. The mortgage loan officer can give the credit report to the seller or the selling agent, the listing agent, if the buyer gives the okay. So as long as
just for agents that don't know, DU stands for what?
Yeah. So DU is desktop underwriter. It's real simple. We use an objective, every lender in the country. It's an approval system. You literally put the client's information into our loan origination system, our mortgage software. You press a button, you wait like 30 seconds, and it either says yes, approved, or no, declined, to keep it real simple. So you can't give a mortgage to no, declined. So once it's yes, approved, that person has a pre-approval. The form that all that information gets transposed on, everything I said, the credit score, the income, all that stuff, it's called DU, typically, desktop underwriter. So all it is a PDF that'll show the seller and listing agent all the true specs of the buyer. And with that, they can make a great decision on whether it's a viable buyer.
It's a great idea to include that with an offer. Next question, Julie.
Yes, Daniel wants to know if you're still doing realtor training or programs for realtors. Andrew?
Yes, Daniel, we certainly are. So marketing at rcgmortgage.com. We have an in-house RCG Realtor Concierge. that department at marketing@rcgmortgage.com, which is obviously Lauren. You guys know Julie and Darryl. So their role is to do a forensic audit with realtors and try to bridge the gap and help them in various ways, whether it's digital, print, etc. So yes, we do tons of training, tons of programs for realtors to build their digital footprint and their offline.
Do me a favor, write that in the chat, that website again, while Julie gets to the next question.
Wonderful. Loan options for expats coming back to the US to buy a house have no employment history for 2 years. Can a 20% no doc work for them?
It depends, right? It depends on their legal status. There's always caveats now, especially with the new presidency, work permits or employment documents, what it is. So it's always a potential. Yes, if they made money in a different country, they might qualify. But to that question, I would answer, what is their legal status? Are they member citizen, permanent resident, or non-permanent resident, which could be visas, EAD cards? It opens up a new can of worms.
Awesome. I want to be respectful of your time, Andrew. So I don't know if you have a few more minutes to take a few more calls. I'm going to try and look through the chat. If we don't get to your calls, please know this, that are your questions. We are going to pull the chat and the Q&A and anything. I know, Andrew, your team will help us answer anything moving forward. But a great way to do it is we have this live, the video up in Facebook. Andrew and Lauren are both in that Facebook group, so they are happy to answer questions there as well. So I just want to be respectful of everybody's time.
Yeah, so Christelle, you asked, is there an alternate document report for the DU? Some mortgage broker believes they're violating customer privacy when sharing it. Listen, my takeaway, especially in dog-eat-dog New York, is if the client is okay with it, then it's definitely allowed. And in this market, right, wrong, or different, a seller's market, buyers are okay with almost anything. If a buyer is okay paying for a seller's moving expense, sure as anything, they're going to be okay if the seller sees their credit score and a couple different things. So I think that some mortgage guys don't like it to be forwarded because sometimes the listing agent has an in-house lender they think will beat the offer, so it becomes a little dog-eat-dog. But if a buyer says yes, for instance, like if a mortgage guy says, hey, I know a guy at Allstate, he's got great homeowners insurance. Do you mind if I give him, like, if you ask and the person says yes, then it's not a violation. If you do it without the person saying yes, it's illegal. Make no mistake. But if the buyer says yes, right now people will do anything for their family to get a house. So I think there's something else to that question.
Yeah.
Thank you so much. Jill says, I have a property that accepted a USDA offer and the loan officer ordered the appraisal 2 days after acceptance. No appraiser accepted the appraisal and the buyer had to pay extra money for an expedited appraisal. Unfair to my seller, is unhappy because we are not closing on time, 10 days late. How do I, as an agent, make sure this doesn't happen again?
Listen, sometimes there's nothing you can do because you as an agent cannot control the market. For a while, because of the refi boom, appraisers were all over the place. Some people, and it's just hit and miss. Some, you give them an order Monday, they call Tuesday, they're there Wednesday, reports back Friday. Some you give them the order Monday, they don't make contact for a week. And then from there, it took another 2, 3, 4 weeks for the report. So it's a market thing. There's nothing you can do per se, except wait until it cools down, which it is. But what you're running into has happened multiple times before you. And I'm just saying that to make you feel a little bit better. And it will happen probably a little bit longer, that sometimes, the taking away control of appraiser, it's good and it's bad. It's good because there's no value collusion. It's bad because some appraisers on these panels are just not as good as the next. And there's nothing you can do about it sometimes. It's just bad luck.
Right.
Well, I think we've proven one thing today, that we definitely need to have you on again and soon, Andrew. A lot of people have questions and concerns, so I so appreciate you being on the call. What do you think of down payment assistance?
Down payment assistance is great. It's just sometimes those are low down payment options. So there are some, listen, why would you put down 30% when you could leverage a house at 3%? For every 10 grand, it's like, I think $42 a month, something like that. So wouldn't you want to save that and then put it into the house for, for upgrades and various things versus getting like a Home Depot card, credit card? It's a listing agent. Listing agents and sellers have all the juice right now. So although down payment assistance programs are great and have a great part in the market, why would a seller entertain that offer when the next guy is putting 30 or 50% down? So all they're great, you're going to have a very hard time getting accepted offer typically, because again, it's typically lower down payment.
Fantastic.
All right, well, great. Andrew, so is there anything you'd like to say to close this out?
What can I say, Darryl? I mean, look, I'm humbled and honored always to be a part of your guys' Power Agent Network. I mean, as you know, I bleed Power Agent. You guys are great. And my hat's off to Darryl. He's built the perfect consultative group for you guys. And especially, I mean, look at the draw. You know, I've done so many of these across the country with so many different realtor groups and various things. And, you know, Darryl's people are so loyal. Why? Because of Darryl. You know, he does a great job giving you guys true value. You know, there's a lot of companies across the country, guys, coaching alike, where it's, you know, the value, it's a little bit iffy, but make sure you pay attention. You do what he says. You follow his lead, because I promise I'll never steer you wrong. So thanks again, guys.
Well, Andrew, that was very nice and sweet of you to say, and we believe in you too. That's why we, as Julie said, we're very selective. I like to think we have a high standard of who we let into the Power Agent family. That's part of what we promise Power Agents, is that when we recommend a company, we put our name behind it. So we vouch for them. And you've always done an awesome job. So I really appreciate you making a difference today with the Power Agents and enlightening them and educating them. And yes, I concur with Julie. We're going to bring you back so we could do this again, and maybe we'll just start with questions right out the gate, so everybody is taken care of. All right, so Power Agents, there you go. Andrew gave us a lot of great stuff. So today's Thursday. Make sure you you get ready for the weekend. Have a great weekend. Stay safe, stay focused, and of course, don't forget to keep smiling. Thanks again, Andrew.
Thanks.
Thank you, everybody.